Welcome, everybody, to the Steps to Soul podcast. Today, our new topic, organizational mistakes that can derail a sale, how to set your business up the right way to sell, with a guest host today, Mr. Nathan Hammaker, with Hammaker Tax and Consulting. So real quick today, Chris and Nathan, we're going to focus on the costly organizational and financial missteps that business owners make all the time, sometimes knowing and unknowingly, that will help devalue their business and hurt a sale. So with that in mind, we're talking about legal structure, key financial practices, bookkeeping red flags. Nathan, this is going to be your time to shine. But start with, let's look at some common mistakes. You've spent years building your business as a seller. Maybe you knew how to use QuickBooks. Maybe you don't. Maybe you have a bookkeeper. Maybe you don't. Maybe you have the wrong entity you started with, how they started the company. You never thought about, hey, I've gone 10 years. I need to be in a certain type of LLC. Nathan, give us a little insight today, on your, first off, on your practice, but, the common mistakes you've seen while practicing, things that you see in deals that we've done. I know you've helped Chris on some deals that you say, my God, that was a silly common mistake. How did you make that?
Yeah, probably it really starts with, people always just say, well, I'm a business owner, not an accountant, so I don't know what I'm doing with my books, and they just kind of play stupid with that regards, and it rock and rolls, and, an accountant cleans it up throughout the years, and they get a tax return done, and then they get ready to sell this thing, and here they are, they've been paying all this personal stuff out of the business, and so then they bring it to the table, for somebody to look at, and it looks awful. It's just junk, so, that's probably the biggest thing. They don't, have a clean set of books. And then, second to that, they've got some entity structure that, they set up when they first started, but they never revisited. And look, starting out, you might not need some S-corp partnership or whatever, but, maybe now that we're down the road and we're looking to sell this thing, we see this a lot where somebody's in the wrong type of entity structure, and then they end up getting hit with additional taxes that they shouldn't, if they would have just fixed something years ago.
Absolutely. So Nathan, how long have you been practicing for?
So I've been practicing, I guess, 17, 18 years. I was at a prior firm for 15, and then I opened my own firm in October of last year.
Awesome. So you've probably seen it all then. I know we've seen a lot, but you've probably seen it worse than us, having to go in and clean it up. And I think that's a highly under discussed point in our industries. We talk about get the financials clean, but no one talks about the time it takes sometimes to get them clean, or when the requests are made, like for SBA loans or other transitions, the time it takes to go in there and actually for y'all to do the work. And I think that's undervalued, underappreciated, because I can't imagine going through 2 to 5 years worth of books. And how often do you have to go back and really, I guess, how much time does it take for you to clean an average transaction up is a good question. How long does it take to go back and fix that 2 to 5 year window of books and get it looking correct per se?
It just depends. It all depends, basically just how bad off it is, and then what they're trying to accomplish. Or is somebody trying to take a cash basis set of books and, and look at it on an accrual basis, that can be extremely time consuming, it just all depends how much of a mess it is. Do they have an accounting software? Some people, y'all see this, they roll in, they don't have anything in place, they're using the Excel set of books, where they just tally up receipts and stuff, so it just all depends.
Hey, Nathan, let me ask you a question. You just brought up a great topic, and I'm dealing with a transaction right now where it's a cash basis, large business, but they've been reporting on the cash basis, right? So everything's when they get the cash and when they pay it out, right? What is that going to do when a buyer comes in, and it's going to be a private equity buyer? This is a really large transaction. When they do that Q of E, how much time is that going to take them, and what do you think they're going to adjust and find changing all that stuff? And it seems like it's going to be a nightmare to me. I'm not quite into that process yet, but we're going to be there soon. What does that look like, and have you seen that before?
Yeah, so, people tend to do cash basis because it's simple. It's easy. Okay, cash is cash. Income is whatever hit the bank account, expenses are whatever got paid out. Accrual basis accounting, which is built around matching revenue and expenses, and so it's supposed to give you a more accurate picture. It takes time and could lead to more adverse tax consequences, being that you might be paying taxes on income you haven't collected yet. So the time consuming piece is just gathering the data, because probably the people have never put together that information. They've never, recorded a provision for inventory. We got to go back and look, okay, all these expenses that were paid on a calendar year taxpayer, they were paid in January, February, were they really, payables that we should have booked? So the biggest time consuming thing is taking something that somebody hasn't done. It's not like we can just click a button and then trying to recreate the wheel from that.
Yeah. It seems like it's going to be a bit of a nightmare when we get to that process, but we'll see how it plays out.
No, you're not wrong. That we deal with that all the time, and unfortunately, Q of E's tend to make that process more painful than it needs to be sometimes. Unfortunately, and for those who don't know, that's a quality of earnings report. If you haven't seen one yet, and you got a big business, we talked about it last podcast. Get ready, get one done in advance if you can. It'll make your life a lot better when you get a buyer. So Nathan, let's talk about some legal structures. We did a lot of common structures. You see an S corp, LLCs. You even see some sole proprietors still out there, surprisingly. Which structures do you think are the least advantageous when selling a business, and why?
The one you probably see the least is a C corp. There's certain times and places where C corps are necessary. That's just probably what you see the least amount of times, because you think about a C corporation, that's your big guys, ExxonMobil, Apple, et cetera. And those are those entities that you hear the treacherous double taxation, because in order to get money out, you got to pay a dividend, and it could create some problems. So those are, you don't see those very often, but on the flip side, there are some kind of random tax rules. Like if you're buying a business that you're looking to sell in 10 years, which a lot of people, that they're not starting a business and saying, oh, I'm going to sell this in 8 to 10 years. There are some weird kind of tax rules. You can get some benefits on the sale of like qualified small business stock within C Corp. So they can be useful. There's a time and a place for them. It's just most people, the default is everybody go, I heard this years ago, LLC, lawyer's likely choice.
Well said.
Everybody's going to kind of just go LLC because it's simple. A lot of times people, they go on to, in Louisiana, we have GoBiz, they go on the Secretary of State, file these documents, and it's just easy. So C Corp would be the least, likely.
You brought up an interesting topic I haven't heard a lot on, is you said the early on with the C Corp, it was something with the employee benefit plan or early startup. Discuss that a little bit more. I've never heard a lot on that.
There's like a sale. You can exclude the sale of like qualified small business stock. I believe it's like in the, if you have a C Corp stock that you sell in the first 10 years, you get some federal tax advantages to that. It's really hard to hit that magic number, because it's like, all right, who right out the gate, I'm going to start this business from day one and I'm planning to sell it in 10 years and I know it's going to be worth $6 million, or whatever. That's kind of a weird window to be under. But, it could work in like you talk about like a private equity deal where these guys are coming in and then maybe they know they're going to sell the deal, or turn it over pretty quick. It could be something to look at.
Interesting. I'd never heard of that. That sounds like I could see that a lot for someone like doing a franchise deal, Chris, where like, hey, I know I'm going to like open a Crumble Cookies. I'm going to grow it for 7 years and then try and unload it in the next 3 years where I know I'm going to I can get out of it. That's not a bad little tip there. I'd never thought of it like that before. Have you seen that, Chris?
I have not seen that. I've never heard that, Nathan.
Nathan
and I haven't discussed that in the past. That's brand new information.
That's not a bad idea though, for all those people listening out there. You want to start something and you don't want to have it forever. That's a great little tip. Let me ask you this, Nathan. Always there's two kinds of sales: stock sale, asset sale. We all have a baseline understanding of what the differences are, but give us a little of your insight on kind of the tax implications and why, I guess maybe let's dumb it down for those folks who don't know the difference. Explain an asset sale versus stock sale and some of the tax implications on both sides, because I feel like people understand them, but don't always understand on a deeper level. And being you're the expert, you have at it.
Yeah, so stock sale, probably simpler to think of. Somebody just comes in and we got an existing business. Somebody basically just steps into the shoes and keeps rocking and rolling with it, They keep that same entity, etc., moving forward. Asset-based sale, somebody forms a new entity and they buy all the assets of the old company. Basically stock sale, you're assuming all the liability of what's happened in this company, or known and unknown in the past. So sales tax audit, pending litigation, etc. Asset sale, you're starting this new company, but what people get confused about a lot of times, is you've got a company with an existing name. Even in an asset-based sale, you're still going to have that name. You're just going to, you're going to basically just form a new entity. There's a company here in town called Overhead Door, and they did some work for us, and I noticed on the invoice it said ERJ LLC. Nobody knows what ERJ LLC is, but on the very top it said Overhead Door Shreveport, and the first thing that popped in my mind, this was an asset-based sale. Somebody bought Overhead Door, and nobody in Shreveport knows what ERJ is, but they sold it, but they're still operating as Overhead Door Shreveport, and they're not a client or anything. And that was my initial thoughts looking at the bill,
No, you're correct. We see a lot of times, at least in my experience, and I'm sure with Chris, you see asset sales tend to be more on the lower side of the value of deals that we do. When do you see a point often where a sale hits a certain size volume, Chris or Nathan, where it kind of hits that hey, this is going to be a stock sale no matter what, just because it's so big, or there's so many moving parts that doing an asset sale is almost too hard to cut dry and form a new entity and move everything all the way over?
I'll start with that one. The only time I see a stock sale is if there's a reason for a stock sale. Past deals have included because there were contracts in place with vendors or customers.
Yeah, no trade
and
calls.
Nobody wants to go back and redo 50, 100, 200 contracts with however many customers or vendors they have. So that's one reason why stock sales happen. The other one is I've got a deal I'm working right now. The real estate's in the business, so it's not two separate entities. And the real estate is on a loan where it's a 3% interest rate. You want to keep that loan in place. It's a very large loan. So you want to keep that in place. So it has to be a stock sale because the buyer is going to be able to take over that loan with the bank as long as the bank's approving it. And that's a huge reason. It's worth a lot of money in savings on interest. So usually when a stock sale is happening, there's a reason for it, because buyers, like Nathan said, they don't want to take on that liability, that unknown liability. Yes, they're willing to take on known liability and they can account for it and do things, but you never know when something's going to pop up down the road. A lawsuit could happen and you're still that entity for a product that was sold 5 years ago. And now you're involved in this lawsuit and you may have reps and warranties in your purchase agreement, but you still got that nightmare on your hands now.
Oh, absolutely. Nathan, let me ask you this. My dad always taught me when doing this in this business that, often, surprisingly, a stock sale is more favorable for a seller. Is that the case, or is that just something my dad thought was the case for some reason?
You're absolutely. It's way more beneficial for the seller, but whereas an asset-based sale is normally more beneficial to the buyer of the business. But here lately, I don't know if you've seen this, or it seems like these smaller, private equity guys are trying to do these stock sales. I don't know why. It's not beneficial. They would be more beneficial to do an asset base, but maybe there's a threshold to where somebody says, on a super large deal, they would rather do this stock sale, especially you've got master, these service agreements and stuff for oil and gas company, MSAs and stuff like that.
Nathan, talk about the tax implications, because I know I called you yesterday and ran through a scenario where we're looking at doing that stock sale like I talked about. What is the tax advantage from a seller, or tax disadvantage for a buyer of a stock sale versus an asset sale, especially on a business with a lot of equipment? It's been depreciated. Talk about what kind of percentage we're looking at in change of tax on that.
Yeah, so stock sales pretty straightforward. Whoever basically the seller of the company is going to pay capital gains tax on whatever they get. So let's just use round numbers, $1 million. At the federal level, that's going to hit at about 20%. You know, the way that, you know, you got 15%, but it gears up to 20% once you get over a certain threshold. On the flip side, the buyer in a true traditional stock sale where you don't do any sort of like elections or, you know, you've got all this special tax stuff that you can do. Just a traditional stock sale, though, the buyer, you know, let's say he's paying $1 million, is not going to deduct that. You know, it's going to be like if I went out and bought ExxonMobil stock today, you know, that I don't deduct that. That just sits on my balance sheet. That's my cost basis, you know, individually in ExxonMobil, and I can use that to offset any proceeds when I do sell in the future, but I don't get any benefit now. So the buyer of that business, and again, just traditional stock sale, no elections or any weird deals, you know, is basically going to be paying out, you know, it's going to create phantom income, you know, because he's taking on debt, making principal payments to buy this business, and he's not getting any tax advantage. You know, so again, he's basically shelling out cash, you know, from profit. Tax-wise, that could bite him. Whereas an asset-based, you know, he's going to buy all the, you know, fixed assets, machinery, and equipment, and he's going to restart the depreciation on it. You know, he's going to start writing all that stuff off. And we've been in this environment for the last 20 years where, you know, you get bonus depreciation on all this stuff, you know, so he's going to get immediate write-offs, you know, on some, you know, furniture, fixture, equipment type stuff that he wouldn't get under a traditional stock sale.
Perfect. Well, let me ask you this question, Nathan. You know, all the time we see owners come to us, they've kind of got their books, maybe their books are in line, but their company structure is an issue. When should a business owner consider reorganizing and how that could affect their tax implications? Is there a certain amount of period they need to do it before a sale so they don't have any clawback from the IRS? Or is there any tips you would give to say, hey, if you're thinking about selling, you should think this long before, or you should at least consider X, Y, Z? What are your thoughts there?
I don't know. I mean, y'all probably tell people this too, but like, I mean, people really need to kind of have a come to Jesus meeting about 3 years before they're ready to sell their business, which nobody does. You know, something maybe medically happens, or their key employee walks out the door and they say, I'm done. I'm ready to sell this today. You know, there really needs to be about a 3-year period where you just clean this up, you know, take the personal stuff, stop paying it out of the business, you know, and I'm not saying create fake books, just, you know, make the books only reflect true business expenses that another buyer, you know, would incur. And I think that would be at the time to say, all right, is this the right entity structure? You know, it's just hard to get people to think 3 years out, because normally we're like, you know, in a situation, let's get rid of it today.
Let me ask you this. Is there any clawback time from the IRS? Let's say we had a client come in, we get a deal structured, it's about time to get an offer and acceptance, and they want to change the organizational structure then. Is there a clawback time between then and the sale date? Like, can they go back like 6 months? Is it be a year in advance? Like, what's a safe landing spot to be in, per se? I know every case is different, but.
Yeah, so most operating entities that generate a lot of, you know, earned income are S corps these days. That's probably the entity of choice. And so, in order to make an S corp election for an entity that's been in existence, let's say, you know, for years now, they've got until March the 15th to make the election retroactive to January 1. So we're looking. Somebody comes in the door today and says, hey, I want to become an S corp, you know, and they've been in business for 10 years. The earliest we could make that election would be effective January 1, 2026. And we got until March the 15th, 2026 to make that election.
That's a great note there.
Yeah.
So
I never knew that. That's fantastic news, because we do from time to time get issues like that, Chris. I never knew there was only that short of a window. I did not know that
because I work with Nathan Hamaker. So
well, you're lucky. Yeah. You're lucky, man. You get that kind of insight.
He's changed several of my entities over the years, and so I work with the expert.
No, we're lucky. Ours have been pretty stable for the last 25, but I have an S corp that pays myself, and that's the best way to do it. It's so much easier. Yeah, let me ask you this, Nathan. You know, You talked about accrual versus cash-based accounting. You talked about separating personal and business expenses, which is also important in keeping books clean. But why is accrual-based preferred over cash basis for valuations? Give us a little insight from your background. We like it more for obviously doing the adjustments, but why do you think it's important for the CPA side for it to be accrual based?
Well, so from a tax return standpoint, people normally don't want it to be accrual based,
Mm-hmm.
And if you're under, it's this big threshold, like $25 million or something in gross revenue or something, you're fine just, keeping it cash basis,
Mm-hmm.
because people don't want, like a tax preparation business, people don't want to pay tax on money they haven't collected,
Yep.
But on the flip side, you see it a lot like in construction. If you take a construction
Mm-hmm.
business that's cash basis, and let's say you're building a house and you walk in and you give the contractor $200,000, down to start building your house under a pure cash basis, that's income right off the bat to him.
Mm-hmm.
And let's say that's December, and then he starts, pouring, doing dirt work in January. So you take 1 year, I got $200K of income, and then the following year, I've got all these expenses with nothing to offset.
Boom.
So under a accrual set of books, you would book entries to make that line up more smoothly,
Mm-hmm.
And so, and similar, you might see a tax prep business, maybe they go out and a CPA firm hires additional part-time help during tax season,
Yep.
So under accrual, they're going to be recognizing the revenue before they get it, because and it's going to match with maybe the contract labor or the additional costs they have, like for a seasonal business, as it basically with the revenue.
No,
Nice.
no, great stuff. Very, very true. And I think that's the hardest part of us evaluating, for example, medical businesses is so hard because you have so much bad debt write-off for Medicare or Medicaid reimbursement claims that you can see a company have all this bad debt write-off and it drops the number down, but they're obviously overbilling, knowing they're not going to get fully compensated. And I see that. So that it gives me a good question.
Yeah, I mean, that's a great example too, because they've got all this payroll going out the door.
Mm-hmm.
It's associated with none of the revenue coming in, because they're waiting on insurance to pay it out, So
that's a good question. So let me ask you this. What industries, I know we just mentioned medical, you mentioned construction. What are some other industries that could be red flags for potential buyers? Say, hey, if you're going to look at these books, just be aware that the books are what they are, but it doesn't mean that's the true cash flow of the business. What other industries would you say, hey, if you're looking to buy, be a little more cautious when first reviewing these kinds of companies or types of industries?
Yeah, I mean, seasonal, which people should understand.
Yes.
Being if you're buying a fireworks stand, you should know you got 2 weeks a year, to make your money.
Mm-hmm.
That construction is probably the hardest because there's so many moving pieces, and you've got retaining, you've got stuff that we say. I mean, you could easily see how a general contractor.
Work in progress, baby. That's impossible to calculate.
Yeah. That's really hard, to track and keep up with. And they've got a big lag sometimes, in collecting money. That would be the one, right off the top. And then you've got a guy who he's great at building houses, but terrible at doing books,
Yeah.
Yes, our lenders don't touch construction very often, Chris. I think especially GC construction, maybe some specialty like masonry, how often do we see construction companies get funded by SBA? It's tough.
No, and it's one of the hardest things to sell to for a broker. The deal I had in New
Licensing.
Mexico, they had 20 construction projects. When we were trying to make the deal happen, and the buyer was asking the seller, estimate how far you are along. We're working on a $30 million deal, and we're expected to come up with estimates of percentage of completion that are gonna, it's gonna affect the transaction millions of dollars. So it's it's definitely a dicey situation when you're asking for ballpark percentages of completion.
No, we fight that. We sold a large pool company here in town, and that was one of the hardest deals was, work in progress for these pools. Cause sometimes you get a deposit, you pour a slab, then you got the finishing work. You could have 7, 10, 15 different pools going down. all changing by the week. And I want to know today for the closing. It's like, well, we're doing work right now.
Right.
I don't know what to tell you. We could give you an 80, 90, 95% pretty dang accurate statement, but unless it's raining, we're working. Especially, well, in South Louisiana, it's always raining, so I don't know when anybody works. But Nathan, let me ask you this. You mentioned, the contractor's great at building houses. He knows what he's doing, doesn't do his books right. What are kind of the most common errors you see with bookkeeping? Not I'm not talking the personal expenses being added in, but what are the common bookkeeping mistakes that you see, even from bookkeepers who probably are doing a decent job, but maybe backlog of reconciliations or not putting stuff appropriately in cost of goods, or give us some insights there where you see where people could maybe take a closer look themselves and make sure they're not making those mistakes or not falling behind on those issues per se.
Yeah, probably. Like the biggest thing that you see now, so everybody, a new business starting out is probably going to go with QuickBooks Online.
Mm-hmm.
And the first thing they're going to do is they're going to sync their bank account, sync the business checking account. They're going to sync the credit card account. And so you've got this feed in QuickBooks Online. The feed is kind of the temporary area. It pulls in all the transactions, and then you have to code them before they ultimately hit your financial statements or your set of books. Mm-hmm. Okay. So you got this temporary area. Well, then somebody does that, they set it up and then they ignore it for, 2 or 3 months or until tax time, or they maybe do the bank account, but not the credit card account. And so then they go in there and they start, I got to code all this stuff. Well, what happens is like, if you're not consistently doing it, sometimes like the feed will get dropped, like, if you got an Amex card that's got multi-factor stuff, if you're not constantly doing it, it's just technology. And so the biggest thing is like the feed gets dropped, they go in there and just code what's ever in there. So, and then they don't do a reconciliation. So when you go to do a tax return, you've got months of missing information, and you look at the top, it's like bank balance, QuickBooks balance, and it'll be drastically off, but 0 transactions to categorize. And I mean, that's probably the biggest thing is not reconciling, because when you do reconcile, you'll realize you're missing this huge gap, and it might be months of stuff, I mean, that's probably the biggest thing, especially with like newer companies.
Let me give us a good anecdotal story of something you saw that was just makes you punch your head against the wall. And you can not name names. We can keep confidentiality, but give us a good anecdotal story of that for people out there listening, this could be you.
Why? Same thing. You get into somebody's books, people don't know how to reconcile their books, whatever. So you go to do it, and you pull up like, all right, you're doing it monthly. You do January, February, March. You get to April, you pull up the bank account, and there's nothing. You got a business that's got 600 transactions a month in like April of 2024. There's nothing there. How do I get 600 transactions? I'm not keying it. I mean, there's software out there too. That you can use. You can take a PDF bank statement and convert it to QuickBooks. But I mean that's probably one of the biggest things is just having this large gap of information, and how do you do it, time consuming. And then on the flip side, when you're doing someone's tax work, let's say you got to get that 600 transactions in there one way or another, okay, in order to do the tax return. So you do that, well, you spend all your time basically digging a ditch, and like when it comes to tax planning, it's not like someone's bringing you a clean set of books and you can look and say, all right, what do we need to do? When you have something that's a mess like that, you're just trying to get it done as quickly as possible to move on to something else, because this took way longer than you initially thought.
Hey, nothing I love more than ask the accountant on the P&L. That is my favorite thing to find at the bottom. That just makes my day every time.
I was going to say that. Do people actually ask you, Nathan? I mean, or do you just see it there and they forgot to ask you? It just shows up.
It just shows up, and a lot of times what it is, and there's like QuickBooks has a lot. If the transactions are all in QuickBooks, there's some really cool features. They've got like a mass reclassify thing in online and desktop. So like I tell people like, look, don't worry about coding it wrong. Just do it consistently the same way. Mm-hmm. Give us a set of books and we can mass reclassify stuff all day. As long as it's in there to begin with, that makes a huge difference, So
See, that's good advice right there, folks. Just get it in there and keep it consistent. Let them fix it. That's what you pay them for, right? That's where they get the big bucks. And we, us novices over here, us neophytes, have to figure out how to work QuickBooks on our own. Let me ask you this question. I'm sure you've seen a bunch of the PPP, EIDLC loan credit loans. How much of that do you see still on people's books, or do you see some that's kind of faded out? Because a big issue we face is we have to kind of negatively add that out of a lot of the transactions that we do, and owners don't get. Why is PPP money a negative add back? Because it's free money you didn't generate. Like, it boggles my mind how you think that's considered income that you earned. But do you still see a lot of that on people's books today, or do you see that's kind of, hopefully that wave has been pushed aside and out of our headache, hopefully for the next couple of years? Doesn't come back, fingers crossed.
I agree. We're not seeing it near as much, and I'm with you. I hope it, is getting out. The only thing we now are seeing is EIDL. Just because that's a 30-year loan. It's an SBA. So we're going to sit here and deal with this, and the amortization or the breaking out the interest and principal on those things is a nightmare. You had 18 months of deferment. So then it's in trying to tie down those balances, you're not dealing with like a traditional bank's website, you're dealing with the SBA. And that's probably the biggest issue now. That, and then you still have some of these ERC credits rolling in, and you've got to, basically those are sitting on the balance sheet, and, they get reduced as they come in.
Have you seen any audits from the IRS or any other entities coming back looking for those PPP loans? I've heard rumors in the street that's starting to occur. I don't know if it's widespread or certain amounts, but have you seen anybody come back saying, hey, let's prove you actually used that PPP money for the right reason, or it did just go to your bank account as forgiven?
Yeah, I have not. And the U.S. Attorney's Office is very secretive in what they investigate. If you're under investigation with them, you're normally not going to know about it until it's too late. And so that's going to be the office that's going to be looking at these. We've heard that they've hired people. My understanding is that they're going to start by going after the very, very large ones. The $1 million plus, and again, they're being so secretive, they're not going to give you the information. So let's say it is $1 million. Probably somebody that got $1 million PPP loan, is running a legitimate operation. They had a very large payroll or whatever, and there probably won't be any issues. The problem, the ones that got paid out, I'm not saying none of them, weren't fraudulent over $1 million, but probably the majority of them were under that. The sole proprietor, or somebody just started up a business and said, I had payroll or whatever. So it'll be interesting to see. I just, I don't know what they're going to find. And they've said too, they're going to start, the IRS on the flip side is shifting all these revenue officers to audit these employee retention credits, which were being sold falsely by all these mills out there. You qualify based on supply chain shortage because you went to Office Depot and they were out of staples. That's not a not an ERC possibly. So it'll be interesting. We haven't seen anybody get audited. We didn't crank out and just do a bunch of those. We did one for people that legitimately deserved it, or had reduction in revenue to the requirements. But there's a lot of fraud in that area too.
Yeah, sure. The fintechs got dragged into that. We were talking about pre-show about the fintech banks doing SB loans. They got asked to do PPP, and they were not set up to do that kind of diligence on employers. They're there to make loans, not do PPP. So we're going to see how much that comes back in the next 4 to 5 years. I'm very curious how that's going to affect the market too, because I know, Chris, we've seen how many books have we seen where someone got something they got to account for, and they don't even know where they got sometimes. I'm like, we got to have that number because that's going to matter on the valuation. Right. Absolutely. So, when it comes down to it, everybody wants to save money, Nathan. What are some good tax tips you would give to a potential seller to say, hey, here are things you can do to help mitigate some tax implications. Here's some things you can do if you got family involved in the business you can do. What are some strategies owners can use that we can easily identify as brokers, but also that you think are worth doing for someone to help save some money on taxes? Who doesn't want to pay taxes? Raise your hand. We can all go down the line and we love you, IRS. Don't bother us, but we don't want to pay you either. No disrespect.
Yeah, I mean, there's all this stuff on YouTube, so I could get on here and just make up a bunch of BS tax strategies, knowing that like I'm not doing your taxes and I'm just trying to get,
Uh-huh.
a social influencer, and just trying to get some likes, But there's a lot of gray areas out there. I mean, the biggest thing, like we talked about, is S corps for operational entities, non-passive activities. That helps, with the self-employment burden. With structuring entities maybe as partnerships, S corps, to get them off of the traditional Schedule C type thing. I mean, outside of that, there's various stuff you can do. It's just kind of everybody's different.
Okay. Do you see any issues with people trying to have family on payroll? Do you see that as a problem when you're calculating running books? I mean, I say on payroll, that could be a very vague statement for some companies. They could be fully involved or be 2-year-old children. I've seen it all.
Yeah, the children thing, it's you put it, and I'm not sure, I'm pretty sure it's 8 years old. You put a child on payroll that's less than 8 years old, you're going to get a notice from the Social Security Administration asking what that child did, their duties, their hourly rates, and so whether you want to open up that can of worms, that's up to you. People normally don't like letters from the government, So take that for what it's worth. Is the magic number 9 or 10, and then they're okay to be on payroll? Or is it 14 under employment law? That's a weird. It's just a great, just a weird area.
No, my wife told me she saw the video influencer. You can put your kids on the payroll. I said, I don't think my 2-year-old qualifies for being on payroll. He's already on the credit card every day anyway. So let's find another way to save some money. Hopefully.
Yeah, and that works in partnerships and sole proprietor entities and not S corp entities. So you got to, due to the way the SE tax works on kids under 18, it might not be beneficial. You can get more benefit out of being an S corp and getting the savings at this level, and maybe you give up the little $12,000 or $13,000 payroll to pay your kids,
Let me ask you this question, Nathan. Maybe you're the right guy, maybe you're not, but I think you might be able to help us out a little bit here. A lot of times owners come to us I've had owners ask me a couple questions. One, is there anything that I can do right now that I can set up financially to help with my company, my employees, whether it's like a 401k? Are there any entities set up? Because we've done stock retirement rollovers to buy businesses, excuse me, and they have to set one up. But some other employees have asked us, is it something I should do to help keep employees around post-transaction for a new person, knowing there's a 401k to keep the employees? So is there any way a specific entity can set up different kinds of 401ks or different kind of rewards benefits for their employees to help keep employee retention post-transaction? Because obviously employees, when they see a transaction happen, oh my God, what's going to happen to my benefits? Is there anything that the owner may set up that can continue on for a new owner to keep benefits around, but also keep employees happy that of, or strategies you're aware of?
Yeah, I mean, the type of retirement plan you can do is not going to really vary on the entity type.
Okay.
Unless you're governmental, there's a lot of like 403, 457. There's a lot of these weird plans that they have to use, or school districts and stuff like that. The thing about retirement plans, a lot of times people come and say, I want to set these up for an employee, or employee benefit. And normally what happens is that person leaves irregardless in a year, who wanted the 401k, or they put $500 in it, and they got a $500 match. It's not that much. If somebody wants to do a retirement plan, I think the first question is like, how much does the owner want to contribute, or what's, who's on the payroll in the owner's family. And that's the starting point, because we know that that's going to continue and that's going to justify any cost, whether you go 401k, which is on the more expensive side, or you go simple SEP IRA, which is held at, normally a fund company. So
let me ask you this, Chris. We've seen a couple groups mention us about ESOPs. Nathan, have you ever handled an ESOP transaction and any tax implications there? Because I've heard some wild stories come out with some things that tax benefits ESOPs have now. I feel like it's the Wild West. I'm hearing all different kinds of stories, and I don't know what to believe anymore.
Yeah, man, I've never done it, and I cannot grasp. I kind of have a basic understanding, but no. My understanding too is that there are very large institutional players out there that handle these type deals. Like supposedly there's like somebody Chase, private wealth management, and that's all they do.
Interesting.
It'd be really interesting to see though, and there are some weird rules where the owner can get away without paying a significant portion of tax.
I've heard that.
I do know it needs to be a larger business because there's substantial fees to keep that ESOP going after the transaction occurred, like annual administration fees, and I don't know the ins and outs. But yeah, it's been a while, but I was approached probably before COVID about several groups looking to do that with businesses I had listed, and none of them came to fruition. So I haven't seen the ins and outs of how that actually takes place. But I honestly, here in the past couple of years, I haven't been approached, so I don't know if they're as prevalent as they were.
Yeah, because I heard ESOPs don't pay tax. The corporation doesn't pay any income tax after post transition. I was like, that sounds insane that the government would let somebody just not pay tax.
Right.
That's the rule. Whatever. Hey, power to you. I'm an ESOP.
Yep.
I don't want to pay tax. So, Chris, do you have any other questions for Nathan? Anything specific we haven't covered? I know we've kind of hit a wide variety, and we could obviously go into rabbit holes, but anything specific you want to ask him about any current deals or anything you think he could give you a little insight on that I haven't touched on?
Not that I can think of. Yesterday I called Nathan and we were working on a deal where we thought it was going to be an asset sale, and I asked him, what's the reason for a stock sale and what that's going to be. So, that's Nathan I use for all my questions related to that, and that's what I would tell anyone is if you don't have a great CPA, Nathan may have some availability. Reach out to him. I'll throw this out there for you, Nathan. He ain't cheap. So if you're looking for a cheap CPA, Nathan's not your guy. Just to put that out there. But no,
you pay for what you get.
Yeah, I would encourage people. I want to touch base back on something just business related. If you're going months without reconciling your transactions, you need to stop doing that for one reason. You're not able to make great management decisions about your business if you can't run a P&L and compare it to what you did last year or where your projections are. So if that's the case with your business, and especially if you're a startup in your first couple of years, you should be reconciling that or having somebody reconcile your bank statement to your QuickBooks every single month, preferably by the 15th of the next month. And you need to look at that P&L. And if you don't understand a P&L yet, I would encourage you to get that understanding, because I don't know how you make decisions on business if you don't know what you've made and what your expenses are. So that's a scary thing that Nathan said, that people would sometimes let months go by without reconciling their books.
Now, we see that with AR and AP, and it's like, see a P&L go month after month. Like, how's the AR and AP not changed 1 cent?
Right.
That's inflating your bottom line. It's messing it up. You don't know what you're actually making. And then we can't go to a bank, to your point, Chris, and say, hey, here's what the numbers are. That's going to be a massive red flag, and it's going to cost you a transaction.
For sure. Right? For sure. Nothing kills deals faster than messy books. And as business brokers, I'm looking at the surface of your P&L. I'm trusting it's accurate. I'm not going to audit your books to give you a valuation and start the process. But that buyer they're going to come in, they're going to do due diligence, they're going to do Q of E. And the minute they find these books are just completely a nightmare, maybe they'll stay with it and try to figure it out if it's a great business and they really want it. But I've seen nothing kill deals faster than messy books that are inaccurate or have red flags once the buyer digs in. So keep your book straight. That's a big takeaway from today.
You're absolutely correct. Nathan, anything else you want to add? Any kind of, hey, fair warning, do this, please. If anything I said today that matters, this is what you should have paid attention to.
No, I'm good. I think, this was great. I'll put it together perfectly. So.
Well, perfect. We'd love to hear that. And guys out there, if you're listening, we'll have Nathan's contact information as well as ours at the end of the podcast when we post it. As always, it's great having everybody here. Nathan, Chris, thank you for hopping on board. Until next time, we will see y'all later on the Steps to Soul podcast.
Bye-bye.
Adios.